Good afternoon, good evening to wherever you are around the world. We're very excited that you're joining us today. Our topic this morning, this afternoon, this evening for all of you is about startup growth, about how the market is fluctuating and what will it take for startups to thrive in this environment that we're dealing with right now. As a lot of you know, the global economy has changed. The pandemic exposed our vulnerabilities, making recovery much slower than we anticipated. Other world events are not helping the situation either, sending our economy into really a downturn with inflation, uncertainties in the horizon, and companies basically taking less risk. But this does not mean that there are no opportunities. Opposites. If history is an indicator of the future, this is a great time to innovate. And startups are the greatest vehicle that can drive change, even in challenging times. So what does it take to survive in these conditions? I'm joined by a prestigious panel today who can share their insights from their own experiences, from their own perspective. With me today, we have Themis. I'm not going to try and pronounce his last name. I'm going to let him do that. Joss and Justin, who's also with us, will be able to answer questions remotely. Let me turn over the panel to our panelists and let them first introduce themselves so you know who's on the panel. And then I'll take a little bit of time and introduce myself as well. Themis, go ahead.
Okay, I'm Themis. I'm made in Athens, Greece, so I'm probably the person with the most wired accent in this panel. I'm sorry for this. The co-founder and CEO at NAP Technologies. We are a VC-backed tech company on a mission to reinvent the way that students communicate, because we believe that student relationships tend to be lifetime relationships most of the times, even in high school or college. So we're building products to help students connect without the boundaries of the physical space. Our main product is called NAP, and it is a college exclusive social network that helps college students to meet each other by joining virtual video college parties, and meet friends from different campuses around their state area. Probably the past month, we are working on a new idea. It is called Popster, and it is a photo sharing app for high school kids where they can share their daily real moments directly to their best friends and schoolmates' home screens. It's working with the widgets, so we're using widgets as the main feeds, and we're connecting high school students with their peers. So that's all pretty much for me.
Joss?
Hello, everyone. My name is Joss. My surname is van der Westhuizen, but no one needs to really pronounce that. So my background is a PhD in machine learning from Cambridge University. And I'm born and bred in South Africa, where I did my engineering degree. And a quick, brief background is after finishing the PhD in the UK, I flew over to SF with about, I think it was $2,000 in my pocket, so about 2 months to live if you live in a cheap place. And me and my co-founder at the time were lucky to land a Sequoia Scout check for our first idea, which was actually using Agora, and we were using machine learning to do real-time video correction for video calls. But that idea didn't really take off. And then we subsequently tried a bunch of different other ideas and went through Techstars in 2019 in Seattle. And that was a lot of fun. I guess the idea we had back then was to do automatic note-taking. So sort of creating like an electronic memory bank for every person out there. And we raised some money with that. But again, the traction towards the end of 2019 for that idea wasn't exactly what we were envisioning. So we had to go back to the drawing board, think about things again. Very luckily, this is sort of a quick tip just to put in here. The investors we had then were fantastic and sort of knew that they were taking a bet on us as founders and not on the exact idea. So they were free or allowed us to experiment with different ideas. And then at the start of 2020, we started experimenting and playing with the Oculus Quest headsets, the VR headsets. And fast forward we found some really good traction there with companies. Fast forward 1 or 2 years, we managed to raise another round recently for 4.5 million. And the product that we have now, that's been running for probably a year and a half now in the market and doing pretty well, is to help remote and hybrid companies connect in a new way with their employees. So we create spaces in virtual reality where teams can get together, socialize, create those bonds and connections that they would do in normal in-person offices. And as a result, then you have teams with more trust and better retention, and just a more fun workplace because you can play ping pong with your remote colleagues as though you're in the same place. And yeah, that's where we are now. The company's name is Remio. Sorry, almost forgot.
And Justin, you've joined us. Can you please introduce yourself?
Yes. Hi, everyone. My name is Justin Melillo. I'm the co-founder and CEO of Mona. Mona is the premier 3D world building platform and Web3 social network for the metaverse. And our mission is to empower people around the world to create, collect, and share high quality immersive experiences on the blockchain, actively growing the open metaverse. A little bit of background on myself and how I started Mona. Basically, I've been a lifelong artist. Professionally, been a 3D AR artist for many years. Worked at DreamWorks Animation. I worked on the team that built the first digital human AI at Magic Leap. And last year in 2021, I started Mona with my best friend Matt Hurl. We saw there was a huge sort of gap in the marketplace, specifically for creators who wanted to build the metaverse. Existing platforms hit creators with a ton of limitations, both aesthetic and technical, and creators couldn't really build super high quality spaces. And our vision, our whole ethos is that humanity will spend more and more time over the decades to come connecting with and interacting with others via this digital medium through these interactive immersive worlds. And these spaces, these worlds are built by creators, and in order to have really high quality experiences together in this future of the metaverse, we just need to empower creators and build the tools that they need to be able to succeed. So combining that with blockchain technology, we built a really amazing pipeline that allows creators to build, mint, and sell their own immersive experiences in the metaverse without needing to buy land and without being restricted to a plot of land somewhere. We believe that, like the internet today, there's going to be a limitless amount of land in the metaverse, and really the value of these spaces will be predicated on the actual creative merit of those worlds. So we're just shifting this entire conversation fully onto creators and developers and empowering them. And I guess like a little bit background on Mona and when it got started. We were a part of the Tachyon Accelerator program last year in 2021, which was very similar to like a Y Combinator accelerator. And shortly after that, we raised our seed round of fundraising in September, October of 2021. And then earlier this year, we closed our Series A round of funding, where we raised 14.6 million to build this future of the open, decentralized metaverse.
Thank you, Justin. Welcome, Bill.
Hi, gang. I am so
nice to see you. Well, Bill, I'm going to hand over the stage to you to introduce yourself.
Perfect. I am so sorry, guys. I'm in Salerno, Italy right now, and whatever the system, the calendar didn't pop up when it was supposed to pop up, and so forgive me for that. But ciao, everyone. Great to meet you. Or buen buongiorno, I guess it is for you guys. It's buonasera here. My name is, so forgive me for anybody who's out there listening. My name is Bill Reichert, and I'm a partner at Pegasus Tech Ventures. I've been an entrepreneur and at the beginning of my career, and a venture investor for the last couple of decades. And so forgive me, but delighted to be here, and hope I can somehow chip in and catch on to the thread that you've been going through so far. So
Bill. We've just gone through the introduction. Let's dive into the yes. So you're so it was timely. Let's get into the discussion. We're dealing with what we anticipate to be a downturn in the economy, which is probably going to impact a lot of the startup community, which makes us a little bit vulnerable. But that doesn't, as I mentioned earlier when I introduced this panel, is it doesn't mean that there isn't an opportunity. There is an opportunity. But let's go back a little bit and then kind of move forward. Is all of us have experienced the pandemic. We know what that was like. We know what the changes have brought onto us. We're slowly trying to get out of it. And then the economy is starting to kind of bite us as well. I wanted to get each of your perspective to give us a little bit more insight of, when you started the startup, what have you experienced during the pandemic? How are you trying to get yourself out of it? From the perspective, market opportunities, competition, maybe doing more with less as we're looking forward to what to do to grow the company. And Bill, where you could bring in, you've seen so many startups, you work with a lot of startups, you're an investor in the startups. Let us know what you've seen and what you've experienced. So how about I start with the three startups? Themis, why don't I let you tell us what you've experienced, and then we'll kind of go around the room and get everyone to let us know what they've experienced and how they're going to move forward and what they anticipate to do going forward.
So I'm going to be the first one. All right. I guess. So personally, I believe that crisis feed innovation, because all the tech entrepreneurs are made to find solutions where we face unstable situations. As a consumer media company, I'm working with the same team for 6 or 7 years. When we were college students, we pivoted 5, 6, or 7 times. I don't know exactly. We tried different ideas, and it was we couldn't approach any VC, because as a consumer media company back in 2018, there were just 2 or 3 big players in the social media industry. It was Facebook, Instagram, and it was Snapchat following them. So yeah, they were dominating the whole market. And suddenly, when we had the first lockdown, we realized that there's a need for people to communicate and connect to each other. So if you remember, it was back then when Zoom became huge, Discord became huge, Clubhouse became a billion-dollar company. Also, TikTok became huge. So there was space for different social media companies, and this is when we realized that this is our great opportunity to do more things to connect these college kids to each other. Our insights grew like crazy in the first and second lockdown in Greece, because all the students were trying to find different ways to communicate and meet new people, because they were bored all day inside their house. So back then we decided to give more opportunities than just texting, because when we started now back in 2018, it was more like an anonymous Twitter for college students. So we decided to use Agora and pivot to an anonymous audio-based social network, and it really took off among Greek students. We launched among 3,000 users, and they were spending 3 or 4 hours every day talking inside the app, and that's why we managed to convince investors to help us raise our first capital. So yes, for us it was great. Now we added the video option to as a feature, but for us it was great. Because this crisis and the whole pandemic proved that people need more ways to communicate. So yeah, that's all pretty much. I think it was good for consumer media market and the companies that were building social media products.
Should I just segue right away?
Yes, please.
Yeah, I think from what we saw, like so pre, during, and post pandemic, from our company's perspective, I guess, or the around that time, the things that matter, and for a lot of startups, this is the main thing that matters, is like what does the fundraising climate look like? And I think right before the pandemic, we had a lot of crazy valuations. I think everyone was like, "Whoa, the market is the hottest it's ever been. This is definitely a hype." And then I guess the pandemic started, and there was a little bit of a crash, and everyone thought, okay, it's going to go away. So we had the whole Sequoia memo. We had a couple of people publishing a lot of memos about how to prepare for a downturn. But then unexpectedly, I guess, there was an even bigger boom where a lot more investment came in. So it was like 2 periods of very, very hot markets that we saw, at least. And then taking a quick pause there, or sidetrack, the other thing that was strange to see during the pandemic, or I guess it's good on one front, is that a lot of startups would like pivot or start working on things that were a problem right there and then. And I think this is something you can see a lot of happening in the market. Like, it's a bit maybe short-sighted, but also not necessarily just short-sighted, but also could be very useful. Like people working on like helping distribute COVID tests or masks or something like that as a startup idea. I think though that like there is a problem that you can run into where if you're, I guess, trying to solve a problem that's temporary, there's sort of not really a good path into the future for that startup. We're partly, I guess, to blame for something like that, because we did, right before the pandemic, see a lot of traction happen as a result of everyone going remote with our product. But I would encourage, I guess, other startups to try and solve like long-term big problems as the stuff that I feel really passionate about. Anyway, coming back, so during the pandemic, we saw this like hype cycle happening again. And now it's, if we can call this post-pandemic, I'm not sure. But if we do call this post-pandemic, we are now faced with the like whole public market downturn or semi-recession that's happening. And clearly now it's like a very bad time for startups to raise, or it's harder to find capital. The bar is higher. You have to hit the proper metrics. And I guess like meta effects that we're experiencing that I think is sort of good is in this time, or like with this downturn we're seeing in the market now, a lot of startups are forced to like be a bit more scrappy with their funding, make sure they can last longer, but also not chase things too hard. So they're not blowing a lot of money competing with other companies for like marketing spend or like ad impressions. Instead, they're focusing on making their product really good. It's similar to, I guess, what's happening with the crypto crash in a sense, where like a lot of the crypto or NFT hype is over now. So you see a lot of the actual like crypto diehards who are really working on like impressive products, who are just focusing on product, who are now like getting their time to do their thing. I feel like the bigger market is getting, at least for the startup world, is getting that same time now, where instead of focusing on like, oh, who can like raise the biggest round, or who can get the like most impressions with customers or TikTok views, they're just back to focusing on products that actually make a change and do good to the world, or make life better in terms of good UX. So yeah, very optimistic in that sense, but definitely also, I also think for all startups in this stage or at this stage, it's very important to take a good long-term look at finances and be very strict with how you spend things, and always prepare for the worst case, I guess. Yeah.
Yeah, definitely. These are really great points. I would say, our journey with Mona is we're still relatively young. Starting last year, sort of, I don't know if you could consider the pandemic really over, but sort of as things were opening up more and more, we definitely saw a trend that more and more people were connecting via a virtual medium, whether it's Zoom or in these virtual worlds. And, we saw, I think like one staggering statistic was that in 2021, people spent like 41 billion hours inside of Roblox, right? That, I think they had millions, I think over 12 million people attended the Travis Scott Fortnite concert, right? And so I think, pandemic or not, there's this need for people to be able to connect over distances. And, I think that was something that was really important to us, is to provide that medium for creators and for users to be able to connect in a really accessible way, which is why we love that we work with Agora for all of our voice chat and text chat needs, enabling thousands of people to connect all through the web browser in our virtual worlds. And I think, in order to survive the sort of downturns and the hardships that we're experiencing in the economy, startups just need to be really flexible, and they need to be able to adapt to these different environments and challenges. They should have an agile growth strategy, and they should always have their growth goals in mind when responding to market fluctuations. We're really grateful to have raised our Series A actually right before sort of a lot of this crypto bear market came about, and before this more extended period of downturn. So gratefully, we're very well capitalized now, but I recognize that a lot of startups might not have been in that same situation. They may have raised during the bull market. And I think it's just a really, really important time to focus on your product market fit and really drill down into the most important areas of your business and what will allow you to continue achieving growth, so that you can be prepared for when the market and the economy bounces back. So yeah, I think it's just super important to develop a strategy around marketing and sales, continue listening very, very closely to your users for your market and your customers' needs and goals. I think like one other key thing for us was really building a strong community around creating in the metaverse, spending time in the metaverse, and collecting these digital assets. Having a really strong community will be able to enable a company to weather even the longest economic storms. So that's also really important.
Thank you, Jason. Yeah.
So I get to chime in on sort of from my perspective. So I'd say one of the things that some of us in the venture capital community are seeing is that there is a whole generation of entrepreneurs and investors who have never seen a real downturn. And as you guys can tell, I've been around for a little bit. Actually, actually, I'm only 35, but this is what working with Guy Kawasaki has done to me. So, kidding. So, so in any case, God, I hope Guy's not listening. But so it is. I mean, every perspective in the venture market right now is incredibly warped by the unnatural environment that we've had for the last 6, 7, 8 years, and it is almost funny that some people think that the prices have now come down to realistic. I mean, and they haven't. I'll tell you. I mean, it's very interesting from the venture perspective. What's been going on is that and I worry about entrepreneurs getting trapped in this. There's such a negative association with down rounds that companies are going through these bizarre, unnatural acts to avoid a down round. And so we're seeing, companies doing, instead of doing their Series B, they're doing a safe note, a $20 million safe note, because they don't want to price the round in the current environment. And the flip side of that, which is I don't know, good news, bad news. There's so much money out there in the venture community that the venture guys have got to put this money to work. And so you've got these relatively new funds with VCs who haven't been around that much. And I don't mean to be sounding pejorative here, but that are perpetuating in the private market valuations that certainly didn't make sense before and still don't make sense because of the dynamics and the optics, both on the VC side and on the entrepreneur side. Now, the flip side of that is that you're seeing sort of the second tier entrepreneurs are going to be struggling mightily to raise money. Sort of the top tier with strong investors with deep pockets can fiddle for a little bit with safe notes on the Series B. And we'll see what happens next year when they actually have to price around, or we'll see if we ever get to that point. But so there's still some very bizarre things that are going on in the market that depend very much on where you are as to whether and how it's impacting you. So I think we're going to see some of the culling of the herd, where you're going to see number 1, 2, maybe number 3 in any given sector are going to be able to keep raising money, and the guys that are chasing the sector maybe not. And so that's just bad timing, unfortunately, for some. On the venture side, I think we're going to see a lot of the venture guys have difficulties raising their next fund, because all of a sudden, whereas December 31 or whatever, 2021, everybody was marking their funds to these extraordinary internal rate of return numbers. Now you got to mark your fund. We'll see. I don't know. It'd be interesting to see what the LPs are doing to verify if the funds are reporting accurately the valuations. So you got all this crazy dynamic going on because of the various forces affecting entrepreneurs and venture guys. But over the long term, over the long term, there's just both a ton of money that has come into the space, and there is truly a hair on fire problem that particularly corporates have around innovation and growth. And so a huge amount of impetus in this last wave in terms of capital and pricing happened because corporate investors were flooding into the venture capital market. And so increasingly you see strategic investors being leads and key to a lot of the Series B, C, D kinds of rounds. It'll be interesting to see how the stock market and macro considerations affect corporate investing. But I think this time it is different. You always worry when you say this time it's different. But I do think the corporates are really aware of the fact that they cannot afford not to invest in innovation. And the entrepreneur world is one of the best places for them to find innovation. So I think, unlike previous meltdowns where the corporates tended to disappear for a few years, I think the corporates are going to stick around, and that will be helpful to the entrepreneur community if they are, one of the leaders in a segment. So, I mean, that's kind of how it feels to me these days, if that answers your question, Sara.
Actually, it's a lead on to my next question. I'll start with you, Bill, since you already tackled it. So, okay. If you're today, what would you do today to go out and seek funding? How would you navigate through, corporates or investors? There's so much funding out there. Yeah. How do you go from, a B startup to an A, shining startup to get out there and expose yourself so you can raise funding right now, knowing that, potentially there's a downturn, knowing that potentially there's a risk factor on the side of the investors.
Yeah. No, I mean, the only way to shine is to show continued traction and momentum. I mean, and that's going to be the key. If you are sensitive to the macro environment, then you're not the right kind of startup for venture capital. I mean, sounds like a nasty thing to say, I guess, but that's, consider the way the venture capital industry works. If the venture capital, there are enough companies that are rocket ships kind of independent of what's going on in the macro environment, because they've come up with something sufficiently breakthrough that, the ebb and flow in the sort of macro market doesn't make that much difference, to them. And so, speaking of rocket ships, right? So you look at a company like SpaceX, which, boy, has just, it's unbelievable. It's an unbelievable sort of business model that, just it keeps having incredible momentum. Everybody thought that other people were going to catch up to Elon and Blue Origin and all that stuff, and Bezos just can't quite get his act together, it seems, in terms of that's obviously, guys, you might know, I'm, as an investor in SpaceX, I have a little bit of a bias, sorry. But seriously, in terms of entrepreneurs, so number one is revenue growth. Right? And then number two is margin improvement. And so we'll be, so it's still, well, and then that is then affected by cash burn. So if you can get revenue growth without accelerating your cash burn, sort of sustainable revenue growth as opposed to purchased revenue growth. And that's what I think you guys were mentioning before. Everybody's got to figure out what the clear pathway to profitability is. And so, in the current environment, if you don't have a clear pathway to profitability, you don't have to be profitable next quarter, but you've got to have the metrics that show the revenue is growing without buying the revenue, right? I mean, and your margins are improving, which means your, CAC is going down, which means that your value proposition is catching on, which means your product market fit is better, which means you're hitting the flywheel, which means you're sustainable. So the VCs, will still fund a burning, if you're not burning cash, you don't need venture capital. But so the VCs got plenty of money to invest in companies that have an obvious pathway to profitability. That wasn't true just a year ago, right? Just a year ago, you didn't have to have an obvious pathway to profitability. You had to have a aspirational pathway to profitability. So now I think, everybody's going to be crunching the numbers a little tighter. Everybody's going to be a little bit more cautious. There's going to be a more significant separation between the wheat and the chaff. So get your metrics. If you're an entrepreneur, just make sure your metrics make you a highly attractive investment opportunity. And that's, I think, you may or may not have control over that, but that's going to be the difference between getting funding and not getting funding.
Thank you, Bill. You've been shaking your head throughout this whole time. You must have something on your mind too. Go ahead, Justin. What have you been thinking about?
Sorry about that. Yeah, I had to mute there. I think it's really important to note that now investors actually have a lot of dry powder now that they are looking to deploy. And the biggest risk for investors comes from actually missing out on the next big thing as opposed to placing the wrong bet. So it sort of depends on what stage you're in. When raising money in an economic downturn, a startup strategy really depends on whether they have product market fit and whether they've raised their Series A or not. If you're pre-Series A and have no product market fit, extending or raising at lower valuations now is probably a little more realistic. If you're pre-Series A, if you're in a Series A and you're without product market fit, then it will be a little bit harder to Bill's point there to actually find or to raise at a higher valuation there. So if you're in Series A now, it is really, really important to show that traction and really dial in on your target market and to show that growth. If you can do that, then you will definitely be better off than not. And if you don't have that product market fit yet and you're in the Series A stage, then I think it'll just be really, really important to cut costs where you can, and basically extend your runway there until you can actually find that product market fit and show that sort of pathway to profitability faster, and then show that exponential growth. I think that'll be really, really important.
Josh, anything to add?
I think we covered most things here. Yeah, fully agree. You sort of have to reset your expectations of raising what used to be a Series A or a seed round milestone or target metric is now like bumped up to the next, or like brought forward. So instead of having 1 mil ARR for your seed round, you need 1 mil ARR for a pre-seed round, for example. So it's definitely a bit tougher, but yeah, as Justin mentioned, there is a lot of dry powder out there, but VCs now have the sort of power. The power is back in their hands, and they get to pick and choose. So you still can raise. It's just going to be slightly trickier. And yeah, also agree that if you're not in a great situation, try to cut costs where you can. See if you can either make it to where your metrics look perfect or great, or sort of outlive this downturn and hopefully try again when market conditions are better. And yeah, just adding to Bill, who mentioned that revenue is key. I would also add that if you're earlier stages, so let's say pre-Series A, engagement from your users, depending on what product you have and what stage you're in, but that could also be a very good leading indicator for VCs. So if you're getting 1 million daily active users, then definitely go out and try something.
Yeah, I do think that's fair, and I think monetization of those users is also going to be looked at much, much more carefully than, it was before. So yes, we do look at, those kinds of metrics, and we want to see that the cash is coming in following those metrics as well. So just to sort of chime in on what was a very good point, I think, about activity and engagement. So
perfect. Themis, anything to add?
Yeah, I think that we covered everything. Personally, I believe that it's harder for those companies that are seeking this unicorn status right now, because when you're going to raise $100 million to become $1 billion company, you have at least to present a sustainable business and make more profits than the cash that you're burning every month. So when you're in early stage or on your seed round, all you need is just a proof of concept, just your first metrics, your first engagement to be promising. We used to read about companies who were just raising huge rounds just by having an idea. So this was crazy for me, because I personally believe that ideas are cheap. The whole thing is the execution. This is the most valuable thing in a startup, having a great execution that people are going to like, and this is the most important part. So also investors invest in teams, and they're trying to find people that are flexible to pivot and be ready to change their plan whenever they need. So for me, you have to go to ask for money first when you're growing really fast, so you want to keep up with this hype, and second when you're dying as a company, but you have a really specific plan to save it. You don't have just to raise money and hit a new status as a company. You have to prove a concept, and you have to have a clear plan on how you're going to spend and what are you going to do. That's all.
For those in the audience, if you do have any questions, please don't hesitate to ask questions online. There is a little box out there. But let's continue the discussion. Let's go back a little bit to basic. We talked about funding. We talked about getting that money, pre-seed, Series A. There's still a mechanism that you're required to use to get out there to talk to an investor. Whether it's a pitch deck, a presentation, a networking, meeting those investors, getting connected to the right investors. what do you recommend is the right resources to get you there? And I'm going to do a little bit of a plug for Bill here because Bill wrote a book about this, and I'd like him to share a little bit what he has done because he's been in this industry for quite a bit of time. He's the recipient of these presentations. He knows what he's looking for. So Bill, tell these entrepreneurs, what do they need to first get in the door? If you're a pre-seed, for seed or Series A, those pitch decks are very important. The networking, getting connected to the right people, finding the right investors. I'll let you go first.
Well, yeah, I mean that was really dangerous, Sarah, for you to do this, but so yeah, I mean, and so for the audience here, I started on the other side as an entrepreneur, and I actually wound up somewhat unintentionally being a serial entrepreneur, unintentionally because my first company crashed and burned. So. But then my second company went public, and so then what am I going to do? So I, plotted into a third company which crashed and burned, and so I jumped into a fourth company which we took public again. So I've done a lot of pitching as an entrepreneur, and then in order to raise funds, I have to do a lot of pitching. But when I became a VC, I discovered that a lot of what pitch coaches tell entrepreneurs is not just wrong; it's actually damaging. Because there's some standard templates that pitch coaches tell entrepreneurs to use that do not reflect what we want to hear as VCs. But most pitch coaches think that a pitch is a presentation, and it turns out a pitch is not a presentation. A pitch is not a presentation. A pitch is more like a tennis match than it is a TED Talk, which means you've got to get a good serve in order to get things going on your side. Otherwise, you're going to lose the point, to belabor the metaphor. And what most entrepreneurs don't appreciate is that most of their pitches as entrepreneurs are going to be less than 30 seconds. And they don't, Bill, what do you mean? I mean, I've got a 56 slide pitch deck, and I, whatever, but no, every time you open your mouth, you're pitching. And the only way you're going to get to investors is if you light someone up who says, wow, that's amazing. You can do that? Really? I got a friend at Sequoia who would love to hear this. Or I've got, a buddy at Band of Angels. I got to get you in front. You've got to light them up right at the beginning. Because the other big discovery I had when I became a VC was that investors do not invest with their brains. Investors invest with their hearts. The way you get an investor is not to logic them to death or data them to death or evidence them to death or argue or explain them to death. That doesn't get you to an investor. You got to get them to fall in love. You've got to somehow get them excited. And, most pitch decks, most slide presentations, most, teasers and explainers do not get people excited. They try to educate people, but they don't get us excited. And so you've got to figure out what is it that's special and amazing about what you're doing. And one of the challenges we've had in this, in this market is there just so many startups that are doing something that sounds the same. And so if you're doing something, in anywhere in social media or, in marketing or whatever, there's just so many startups out there that sound so similar. And so you've got to differentiate yourself really quickly, and you've got to deliver evidence that you've got something amazing that nobody else has. And if you don't do that, nobody's going to remember you. Nobody's going to refer you. Nobody's going to pay attention to you. Nobody's going to bring you back to their office and let you pitch to their partners. And so, every entrepreneur needs to figure out, how do I get them to say, wow, That's amazing. Tell me more. Come to my, partners meeting, whatever it is. And that's, within 30 seconds, right? If you get them cooked within 30 seconds, then you have permission to keep talking. If you don't, they might be sitting there smiling and nodding, but they're really checking their email under the table, right? So that's sort of part of what I learned when I made the transition over to venture capital. And so finally, a friend of mine said, Bill, could you just write this down? And so that's the book that Sarah's referring to. It's called Getting to Wow, Silicon Valley Pitch Secrets for Entrepreneurs, at an Amazon.com near you. So thank you, Sarah, for that. But
I've been working with Bill, just to let the audience know, I've been working with Bill for a long time. I've seen him listen to all the pitches. I've seen, the feedback that you provide. So, with all these, with the years of experiences, it's great that there is a book out there that allows entrepreneurs to kind of leverage on this experience. And Bill, why don't you type that on the chat so others can, the name of the book. Justin, do you guys have any feedback? I mean, you're now, tell us your stories of what you think it was required for you to get out there and get some of the funding. I'll let any one of you take charge of the mic.
For sure, yeah. I think those are really, really great points and really great advice. For founders, accelerators are a really great option to get started. We got our start with Mona through the Tachyon Accelerator, and it's structured very similar structure to how Y Combinator works. YC is a great option for founders getting started. Especially for first-time founders, I think going through an accelerator is a really great option because it really does help you get from like 0 to 1, really starting your business off on the right foot, prepping you. Really love the Tachyon team from Consensus Mesh. They really helped prep us to pitch it to investors even before the pitch, weeks before. Establishing really what the pain point was that we were solving, really finding that product market fit or the start to it, and then getting us ready to have those conversations when we had established some traction. So accelerators are a really great option. They prepped us to pitch, several of the investors that then invested in our seed round of funding. For entrepreneurs who are looking for different resources, actually Y Combinator has a lot of fantastic resources on their site around best practices to structure pitch decks. I think a lot of founders kind of get into the spot where they're putting a lot of words and a lot of text on these slides, and that will just make investors fall asleep. So I think there's definitely an art to crafting a really great pitch and story around around what you're building that has that wow factor. There are a ton of great resources. I think if you check out the Y Combinator site, that sort of like have really great examples of pitches and different decks. And I think those are really, really great starting points. And again, I think just coming back to something that I learned and that I've heard from investors, which is that investors really, the loss comes from when they miss out on the next big thing. And so if you can show that you have a ton of traction and that you're onto something really big, I think that will really help to sell investors that you want to bring on board as partners on the journey that you embark on. So hopefully people find those resources helpful.
Can I just offer a counterpoint to something that Justin just said? So I don't know how have you guys have the rest have I don't know how many of you have sat through a Y Combinator demo day. Have many of you done that? So one of the things that they do that pretty much everybody does that drives, and I actually mentioned this to Siebel once, and so he didn't bite off on it. But what drives investors nuts is the slide that has the $56 billion TAM number on it. And Y Combinator still does this to this day, in every 1 minute pitch, what they say is, well, there's 72 million millennials, and if we sell, at $9.95 per month, then that makes it a $225 billion market opportunity. Right? As if, what? Are you freaking kidding me? I mean, and they still do that, and it just drives me nuts. But this whole market size thing that you see in almost every pitch template is doing damage to entrepreneurs in terms of their credibility with investors, because almost every TAM, I don't know, I'd be interested to find out what each of your TAMs is. Tell me what your TAM is, and I'm willing to bet that you don't even believe it, right?
It's the worst slide of it's I hate, as founders, I think we all hate making that slide.
Right, because you don't even believe it, right? But somebody said, these goddamn VCs, they're such greedy bastards. We got to have a big TAM, as if a big TAM means you're more likely to be successful. I mean, whoever thought that one up, right? So in any case, I mean, it seems intuitive that it should be easier to get 1% of a $56 billion market than 20% of a $560 million market, but that's not inherently true, right? I mean, so that's okay. So you heard my rant. You heard my rant for the day.
We actually have about 2 more minutes left of this show. How about I give each one of you a 30-second closing of what you would like to share insight with an entrepreneur. And Bill, you even get your 30 seconds too. Themis, I'll start with you. Give me 30 seconds, give me some insight too.
I totally agree, because I believe that every amazing product and every amazing idea had to start from a really small audience. It doesn't matter if you're targeting millions of people. You have to make it work, for example, for your 5 friends or for your school or something. If it works for one school, for example, it is going to work for every school. So yeah, you have to start small. Also, I believe that pitch decks are a really good exercise for the founders, but they are extremely boring for the rest of the world, because you have to work on your pitch deck to learn how to pitch your idea, how you solve the problem. But if you have a cool product, and if you go to an investor with your product and some amazing insights, a huge engagement, I think that you're going to get their attention. And just to conclude, because we have no time, personally, you have to find something that you love, and the partners as your co-founders to be the people you enjoy to work with. If you do these 2 things, you're going to find the idea and your passion and what you want to work. It's like trying to shoot a basketball from the middle of the court, and you're trying to succeed. You have many times you have many times to shoot, but you need just one shot, one successful shot in our business. If you're an NBA player, just successful shot is bad. But if you're an entrepreneur, you just need one shot. That's all. You have to keep trying.
Okay.
Yeah, I'd say the one I picked today is really work on your listening skills in every sense of the way. So listen to customers is the obvious one, but the non-obvious one that sort of echoes Bill's tennis analogy with pitch is what I found is when fundraising, it's actually a listening exercise, especially for the first 5 pitches you do. You really want to listen for what are those red flags or orange flags that VCs bring up, and then with the next pitch, you want to address that up front. Sort of follow Jack Dorsey's approach, where he sent out a memo for Square when he raised funding, which was, I think it was titled something like 100 Reasons Not to Invest in Square. And that's the mentality you should go in with, like listen and then address upfront.
Advice. Yeah. Take notes during all of your chats with investors.
Well, I mean, and exactly. I mean, what I want to emphasize that point, that every question is feedback, right? So every question an investor asks you is feedback. And it's, a lot of entrepreneurs, they get question, and at the end of it all, they say, well, do you have any feedback for me? I just asked you 24 questions. That's feedback. And so, but in any case, the, my 30-second version is in every communication, not just to investors, but to employees, to recruits, to partners, to customers, to the press, to whomever. In every communication, every word, every sentence, every paragraph, should be tested for, is it clear what I mean? Is it clear what I'm doing? So, I mean, you look at, 20 out of 25 websites, the top half of the website, I still don't know what this company does. How can that be, right? How can that be? Is it clear what you're doing? So, most pitches in the first minute, I'm still not clear what the company does. So you've got to be clear what you do in order for me to get excited. But in order for me to get excited, you've got to be compelling. It's got to be compelling. And what is compelling? Compelling is a 10x benefit for customers, a compelling value proposition that is going to cause customers to say, I can't live without this. So that's the problem, especially in enterprise. An enterprise will not buy anything unless it's a hair on fire problem. So, it's got to be compelling. But then, a lot of entrepreneurs think they're compelling, but they're not credible. It's got to be credible. It's got to be credible. There's got to be some reason for us to believe that what you're saying is true. So then generally that is traction. But if you're not there yet, there's some other signals that give you credibility. So clear, compelling, credible, all of your communications to everyone all the time. So that's my 35 seconds. Thank you, Sara. Thank you.
Thank you very much, all of you, for participating on this panel. Thank you for the audience who've been out there. Unfortunately, kind of quiet because this engagement online is not the same experience as in person. But if any of you want to connect with anyone, please don't hesitate to reach to myself or anyone else on this panel. Once again, thank you, all of you. Each one of you, enjoy wherever you are today, and looking forward to another opportunity to meet again.